So in today's video, we're going to do a comprehensive review of the Schwab U.S. Dividend Equity ETF SCHD. It's one of the most attractive investing strategies, and this fund has consistently delivered strong performances, making it one of the top dividend-focused ETFs available. And I'm very excited to share my analysis with you and why SCHD is one of the best ETFs for anybody's portfolio. Yes, SCHD is also one of the biggest holdings in my Roth IRA portfolio, and if you guys want to see my entire stock portfolio, you guys can follow me on Blossom Social for real-time updates and insights. Just click the link in the description below, and let's get this video started. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which is basically a list of high-quality U.S.-based companies with strong track records and growing dividends. Here's some of the core facts of SCHD that you guys need to know about before investing. SCHD has an expense ratio of 6 basis points, which is basically the tiny annual fee you pay to own it, and it's one of the lowest in the game. In the name of the index SCHD tracks, SCHD holds 100 of the most reliable, high-quality dividend-paying stocks in the U.S. market, all handpicked through a strict screening process, which I'll go into in the next section. Now, this ETF was launched all the way back in 2011, so it's got a solid track record of over a decade to look back on. And as of today's recording, SCHD currently has a 30-day SEC yield of 3.96%. The 30-day SEC yield is the most accurate snapshot of what's actually getting paid out annually in income based on the recent distributions and current price. And like clockwork, SCHD pays out its dividends every 3 months. So you'll be receiving income from SCHD 4 times a year. And lastly, of course, the issuer of this ETF is Charles Schwab, which is actually a very underrated ETF issuer in the market. And they actually have another really popular ETF called SCHG, which is the Schwab Growth ETF. But Charles Schwab is currently ranked the 5th largest ETF issuer with $380 billion in assets under management behind BlackRock, Vanguard, State Street, and Invesco. So how does ETF select its holdings? So SCHD begins its search on the Dow Jones Broad Market Index, comprising of the 2,500 largest U.S. stocks, with REITs and MLPs excluded from this consideration. And these holdings must comply with stringent requirements. In order to be considered into the SCHD ETF, stocks must meet 3 key criteria. Number 1 is consistent dividend payments. SCHD requires a minimum of 5 years of consecutive dividend payments. Number 2 is market capitalization. SCHD requires a float-adjusted market capitalization of at least $500 million. And 3, all the stocks need to be liquid. Stocks within SCHD must have a 3-month average daily trading volume of at least 200,000 shares. Holdings are then rated on 4 key aspects. Number 1 is free cash flow to total debt. This means it wants companies that actually have money left over after expenses to comfortably handle what they owe. Number 2 is return on equity. This number measures how good a company is at turning investors' money into actual profit. Number 3 is the annual dividend yield, which this number is how much income you are receiving per year from any given stock. And then 4 is the 5-year dividend growth rate. And this number is how fast the company's dividend has grown over the past 5 years. And lastly, there's some other rules about diversification. To maintain this diversification, SCHD adheres to 2 key rules. Number 1 is single stock limitation. No single stock can represent more than 4% of the index. And then number 2 is sector limitation. No single sector can represent more than 25% of the index. Now, SCHD's holdings get rebalanced every quarter. So every 3 months, weights get adjusted to keep the portfolio aligned and risks in check. But once a year, it goes even deeper with a full reconstitution of the fund. If any company doesn't meet any of those requirements I mentioned earlier, they then get kicked out. That combo keeps SCHD fresh, focused, and full of only the strongest, most reliable dividend players on the market. Now let's dive into the top holdings of SCHD. SCHD is packed with proven companies. Its top 10 holdings include Coca-Cola, Lockheed Martin, Verizon, PepsiCo, and Amgen. And these are far from hype stocks. These companies are consistent performers in industries like consumer goods, healthcare, and energy. For example, Lockheed Martin builds fighter jets, Amgen develops life-saving drugs, and Coca-Cola and Pepsi basically own every single beverage aisle across the country. Analyst sentiment is very solid based on TipRanks.com, which I have some screenshots here. Coca-Cola and ConocoPhillips have strong buy ratings, while most of the other ones are moderate buys. Only Altria out of the top 10 is rated as a hold. Now, SCHD's sector exposure is mainly towards defensive sectors, with the biggest weights in consumer defensive at 19%, energy at around 18%, and healthcare at around 15%. It also holds industrials and financials, but only technology at a roughly 7.8%. So don't expect it to follow the NASDAQ index during major tech rallies. That low technology weight is what makes SCHD less volatile, which is great if you prefer smoother returns compared to wild rides. This ETF is also 100% US focused, which means no global exposure. So you're betting entirely on America's best dividend payers. As far as outlook to SCHD itself, analysts covering all 101 stocks in SCHD have set a 12-month price target at about $31, which is a 23% upside from current levels. The higher estimates sit around $36, which is nearly a 47% gain, while the low side is around $25, which is right near where SCHD trades currently. Let's take a look at one of the best things that SCHD has to offer, which is their dividend growth rate. A dividend growth rate tells you how fast an ETF's payouts are increasing year over year, and for long-term investors, that compound growth is everything. SCHD has delivered an impressive 5-year dividend growth rate of 11% and a 10-year growth rate of 11.3%, which means while you're getting this high dividend yield, you're also getting a raise every single year. Looking back at the 5-year and 10-year chart on SCHD's homepage, SCHD has done very well for itself, considering that it's a dividend ETF and not necessarily a growth ETF. So in the case of SCHD, it has produced a 5-year annual total return of 17.3% and a 10-year annual total return of 11.4%. Now, this number of annual total return includes both price appreciation, which is the ETF's share price going up, and reinvested dividends, which is assuming you reinvested all dividend payouts back into SCHD. So if SCHD's 5-year annual total return is 17.3%, it means that on average, an investor who reinvested dividends earns 17.3% per year over that 5-year period. Now let's weigh some of the pros and cons of investing in SCHD. First, let's go over the benefits. Number one is strong dividend growth. SCHD has delivered 11% annual dividend growth over the past 5 and 10 years, which is extremely rare. So you're not just collecting income, you're also getting a raise every single year without doing anything. That type of consistent growth is what makes SCHD such a great long-term investment. Number two is the high-quality stock screening. SCHD screens for cash flow, return on equity, 5 years of dividend payments, and more. And only the top 100 companies make the cut. And then they're reevaluated every single year to keep the bar high for SCHD. That means you're getting a portfolio built on stability, reliability, and profitability. And number three, it's less volatile. SCHD leans into sectors like consumer staples, healthcare, and industrials, which is stuff that holds up well when the market gets shaky. So for long-term investors, a steady portfolio like this can be a huge win. Lastly, let's go over the cons. Number one is that SCHD doesn't really focus on technology or growth companies. SCHD avoids those really big names, so there's no Apple, there's no Tesla, there's no Nvidia. So this means when growth stocks or the NASDAQ is ripping, SCHD might be lagging behind it sometimes. But once again, this fund is built more for consistency and not necessarily that high growth. And number two, it only invests in the United States. So you'll be missing out on the growth of other countries like Japan or Brazil, Australia, United Kingdom, and others. So if you're looking for an ETF that delivers steady income, strong dividend growth, and holds up during market dips, SCHD might be the right choice for you. It's built for long-term investors who want to build their cash flow without investing in anything too risky. But if you're interested in an explosive technology growth or international companies, this ETF might not be the best choice for you. At the end of the day, it's all about what you want in your portfolio. So if you're interested in dividend investing, SCHD is one of the best vehicles to do so with. However, with any investment involves risk, so make sure you do your own due diligence before purchasing anything. Please tell me what ETFs to cover next, as I'm always reading the comments. Please follow me on all platforms, and thank you for watching. We'll see you in the next video.